Hi everyone. Today I'm going to be talking about short-term business decisions in relation to managerial accounting. In this video, I'm going to cover how to determine relevant from irrelevant information and how we use that to make business decisions. And then we're going to go over what the difference between a sunk cost versus an opportunity cost is. And finally, we're going to use some formulas to calculate our target full product price and cost plus pricing. Now, the first thing to know is how focusing on relevant information helps managers to make business decisions. In this case, I'm going to use the example of being the manager of a coffee shop. Now, the espresso grinder you have is currently 3 years old. However, you were just notified by the company you purchased it from, and they told you that the newest machine is available for sale. This machine is going to improve the quality of your shots, as well as reduce the time it takes to brew those shots. As the manager, it is your job to determine what relevant information you have and what irrelevant information you have to decide the best course of action for your business. Now, in this case, our relevant information was going to be the cost of the new machine, the benefits that it will provide to our company and production, and any special equipment or parts that will need to be purchased, because those will be an additional cost, such as special coffee filters, special cups for the espresso shots, any of that. Now, our irrelevant information is the cost of the old machine, because it's in the past and it doesn't matter to our decision anymore. So with that information, we know how to figure out what the best course of action for our business will be. Now let's take a look at what a sunk cost versus an opportunity cost means. A sunk cost is a cost that's been incurred in the past and can't be changed no matter what course of action you take. For example, let's say you bought a used espresso machine, and after owning it for about 1.5 years, it broke down. Your sunk cost is going to be what you paid for that machine. And now that it's no longer usable, you have that sunk cost of how much you paid for it. However, an opportunity cost is a cost that's given up when another alternative is chosen. So back to the coffee shop example, let's say you had 2 new espresso machines to choose from and on which one you were going to buy. One of them was slightly cheaper with some really nice benefits on the espresso quality and the time to brew the shots. However, the other one was slightly more expensive and didn't have near as many benefits to your company. You decided to go with the slightly cheaper one because it had more benefits to your company. The opportunity cost here is the cost of the new one that had all these special things but didn't really have those benefits that the cheaper one was going to give you. So there you go. That is a sunk cost versus an opportunity cost. And now I'm going to show you how to calculate using the formula to find your target full product cost. So first we're going to talk a little bit about target pricing. Target pricing is a method of managing costs versus profits by doing the formula that I just told you about, the target full product cost. To calculate this, we're going to take our revenue at market price and we're going to subtract out our desired profit. Now, as a little example, let's say our revenue at market price was $59,000 and our desired profit happened to be $48,000. So we're going to subtract the $59,000 from the 48 from the $59,000, which is going to give us $11,000. That will give us our target full product cost, which tells us how much it's going to cost us as a company to develop our product, deliver it, and any other costs that might be included in there. Now we're going to look at some cost plus pricing. Now, cost plus pricing is yet another way of managing some costs versus revenues and this is going to show us our cost plus price. So first we're going to take our full product cost and then add our desired profit to it, which is going to give us that cost plus price. So our full product cost, as we determined, was the $11,000. That's to make and produce and deliver any of our service or products that we have. Next, we're going to add back in that desired profit, and our desired profit was $48,000. Now, $11,000 plus $48,000 is going to give us a cost plus price of $60,000. So, there you go. I've told you how to determine relevant from irrelevant information and a little bit on how that helps managers make business decisions. We now know what a sunk cost versus an opportunity cost is. And we've got a couple formulas on our target full product cost and some cost plus pricing. Have a nice day, guys.